Hi, my name's Rob Poole, and I'm joined with my colleague, Jeff Braddix. We co-head the equity strategies here at Picton Investments. And welcome to our 2026 outlook. So, Jeff, we've closed the book on 2025. 2026 page opens. A lot of discussion out there around broadening in the equity markets. We wrote about this actually in our Picton report recently. Maybe elaborate a little bit on that and what you're seeing from a portfolio context on this broadening.
Thanks, Rob, and thanks for our listeners for tuning in. Stepping back as a portfolio manager, it's been fascinating looking at fundamentals. And to be very candid, it's been completely uneven on fundamentals. We know the areas of strength, areas like AI. But stepping back, there's several industries, if we look at the last few years, that have really struggled. Some of those are been impacted post the COVID era. COVID saw that surge in demand. Then demand normalized, and these industries have been dealing with massive surplus of inventories. Manufacturing's been impacted. You add in tariffs, which have froze a lot of manufacturing. And then even government sectors, DOGE, government shutdowns. And so I would say what's been really surprising is how uneven the fundamentals have been. You've actually seen quite a few, stepping back, kind of rolling recessions across different industries. Not simultaneous, and meanwhile you have the AI keeping up the economy. Now, as we highlighted in our Picton report, we can see some tailwinds out there. Monetary stimulus, fiscal stimulus in the U.S. with one big beautiful bill. And also, I would say with tariffs, as we meet with companies, we're getting a little bit more certainty where some of that capital investment's becoming unfroze. And so some of those areas we talk about abroad out in the market are interesting because you don't need the cycle to really pick up a lot of steam. But these are companies where inventories have been worked down. They've cut cost. And so the cycle doesn't have to be perfect, but there's a lot of operating momentum in those businesses. Now, meanwhile, as we look at fundamentals, some of the existing themes still remain in the market. Gold here in Canada, and it seems every week there's some geopolitical headline. And the AI theme is still there in the market. It's evolving, to be very clear. For a lot of last year, it was a one-way trade. And now we have dispersion, which we like, between winners and losers. And it's also evolving how it's funded, from purely cash flows to the debt side, which brings in a focus of return on investment. So stepping back with the portfolio, we have exposure to some of these, what we say, positive change secular themes. And then selectively over the past few months, we've added exposure to some of these areas with operating momentum while still managing risk. It would be interesting to hear from your side. You look at financials, epicenter of the economy, credit, get a real-time pulse of the economy is how you're seeing this broadening out play out.
Yeah, no, that's a very good point and good segue into financial services. When you think of financials, it really lends itself to this broadening out narrative. About 80% of companies in the U.S. with revenues over 100 million annually are in the private markets. These are not public companies. These are not top of the index. These are bank customers. These are, in many instances, portfolio companies of the alternative asset managers. And these are really impacted by, the broadening out theme, less top of index heavy. So you do get a really good sense of pulse, and you're starting to see some momentum build across the space. One theme we really like within the financial services space is this notion that we're in the early days of a capital market super cycle. And what you're starting to see here is a lot of the stars are aligning. To your point, CEO confidence is building. You have some tailwinds with, equity markets are near their highs, multiples have re-rated, credit spreads are near tights, base rates have been declining, and you can pencil in a couple rate cuts for next year as well. So you're starting to see the stars align here, and that in itself is broadening out as well. You're starting to see deal activity move away from being just mega cap tech heavy, and seeing much more dispersed deal activity. So this is a theme we're very positive on this year. And when you think of it, there's $4 trillion of dry powder out there in the sponsor community. And this has been aging for the better part of the last 2 years. And on the sell side of the equation, what's really interesting is 40% of private equity NAV today has been aged for 7 years plus. So it just helps contextualize the amount of massive unlocking that needs to be carried out right now. And what makes us really bullish on this is that there's a multiplier effect that rolls through. When you think of corporate activity picking up, it's not just the M&A fees that build the fee pools for capital markets players. It's the M&A fee pools, feed the ECM markets, feed the DCM markets, you need to bridge finance deals, you need FX hedging, and there's this big multiplier effect that rolls in. So this is a theme we really like from a positive change perspective.
That's interesting, especially with financials, as they say, at the center of the economy. Now, we've talked a lot about opportunities out there. Important for our listeners, we also highlight there's several risks in the marketplace. And candidly, I think the market's become a little complacent on some of these risks. And so I would say from a portfolio perspective, especially as complacency is there, vols are low, we've been looking to add protection for our clients. And also in our portfolios, these are hedged portfolios, so we also have offsetting shorts to some of these opportunities. Without highlighting names, maybe some themes you're seeing in financials, maybe for some of the short side of where you're seeing negative change.
Yeah, good point. And the way I kind of like to look at how we address the short side of the portfolio is characterized as we have our funding shorts, and then we have our more alpha shorts. And to my earlier comment on how we're bullish around the capital markets recovery story, we also got to be mindful that we don't want to have a ton of beta and industry risk on that one theme. So what we like to do is scour the universe, look for names that maybe are inflecting negatively, whether it be market share shifts are moving out of favor for them, or they're not exactly geared to the theme, the underlying theme that we see building momentum. So we like to use those on the short side of the equation to enable us to gross up our long exposures there. Those are more of the funding shorts.
Yep.
On the more alpha side of things, we see really good opportunities. And I look at some of the darlings of the last couple of years, maybe to your point earlier, those COVID beneficiaries, and that are now lapping really tough comps and have almost, they beat to a different drum, have a different cycle that they follow. Property and casualty space is one that comes to mind there when you think of this was a really hard market coming out of COVID, and a hard market for property and casualty insurance is really good.
Yeah.
You think of it as pricing is accelerating, margins are tending to improve, but you get to a point in the cycle where that starts to be competed away, where the look forward is premiums are starting to decline in absolute value. Some instances, lines like personal auto is in outright deflation right now. So that's an example of a sector or sub-industry that we look at as incrementally negatively changing at this point. So that's where we find some decent opportunities to hedge the portfolio. So Jeff, what are some things advisors should consider for 2026?
It's interesting, as you mentioned, 2025 and alpha ability. We had our team at Picton do some work on alpha returns, active management outside of Picton, but looking at broader industry. And whether you looked in Canada, whether you looked in US, whether you look globally, 2025 is a complete statistical outlier. A very difficult period for generating alpha for active management. Some of those reasons, we know the first half of 2025 was, dominated by tariffs and geopolitical. It means fundamentals are put aside. It's a big macro trade. Second is that we know narrow breadth in the market, and that's pretty simple from alpha math. You get a small sleeve of stocks that perform, it's more difficult to generate alpha. And lastly, some lower quality factors that tend not to be associated with long-term returns performed well. What's interesting is several of those, when you look over time, are cyclical in nature. And we can actually see several of those conditions changing, which improves the opportunity set for active management, including Picton, but including the broader active management space. On market breadth, there's a direct relationship between market breadth and forward active returns. And as market breadth starts to increase, you see the outlook and the deliverance of alpha improve. And with view of broadening out, more dispersion in the market, that should contribute to that. On geopolitical side, history would say that as you approach midterm elections that things start to quiet down. We'll see on that one. 2026, we're clearly not seeing that. For us at Picton, we're not waiting for market conditions to change. We're focusing on controllables and improving our opportunity for alpha. So in 2025, we made 7 net additions to our team. That's across fundamental, the quantitative team, and our risk team. And so they're working collaboratively as a group to enhance alpha ability, workflow, and our risk management processes. Maybe one last area I'll highlight for investors is some key things to watch in portfolios, potential risk outside of our broader risk, and that we highlight in our Picton report. Some of those is that we have equity drift in portfolios. With strong gains in equity market, the equity concentrations increased. We've seen in a lot of portfolios, people have let that continue to make up for that shortage of active management alpha. We also see a lot of concentration when we look across portfolios. We chatted on our last webinar about the AI concentration in portfolios. And that's important as we move to a broaden out in the market. A lot of people have looked for diversification over the last few years through going global. We'd highlight that actually global equity markets have correlated more with US markets over the last year. And during Liberation, the drawdown period where you need diversification, those correlations were above 90%.
Yeah, very true.
And highlight, one opportunity we see for investors to improve portfolio construction is diversifiers, which in an improving backdrop for active management can be there to help build better solutions and bring greater certainty to investors. So with that, I want to thank our viewers for tuning in today, and we look forward to our next update.